It's January 2015. Two friends, Maya and David, received their first paychecks after graduating from college. Each has exactly $200 left over every month. Maya decides to start putting that money to work immediately. She isn't a financial expert, but she commits to investing a fixed amount every month into a broadly diversified portfolio. David takes a different approach. He feels the market is too expensive and decides to wait. He wants to study the trends and buy in only after the next major crash occurs. Look at this comparison after 15 years. Maya has built a substantial portfolio. David finally started investing years later, but despite earning a higher salary than Maya, he remains far behind. Why did the person who tried to play it safe end up losing so much ground? The difference in their wealth didn't come down to a lucky stock pick. It was determined by the 15-year gap between their first investments. Leaving money in a savings account feels risk-free because the balance never drops. Our brains interpret that lack of volatility as absolute safety. But holding out for perfect conditions sidelines your capital, removing the one asset you can never replace: time. To understand why smart people freeze with money, we must look at loss aversion. Psychologists call this loss aversion. Losing $100 usually feels more painful than gaining $100 feels rewarding. This psychological trap creates a specific persona, the gambler. Because building wealth patiently feels too slow, the gambler chases high-risk, quick-rich schemes to try and bypass the years of waiting. Then there is a second persona, the overthinker. This person consumes endless financial podcasts and books, but they are so afraid of making a mistake that they never actually put a single dollar into the market. Both types are reacting to the same evolutionary hardwiring, allowing the fear of a temporary drop to block their long-term progress. The overthinker's strategy of hoarding cash in the name of safety has a specific mechanical consequence. Imagine you take $10,000 in cash, lock it in a drawer, and leave it untouched for a decade. While your $10,000 remains physically there, the purchasing power of that money shrinks over time. This is inflation. As the cost of goods rises, the real value of untouched money erodes. You hold the same cash, but it buys less. Avoiding the visible volatility of the market results in locking in the invisible, guaranteed loss of inflation. Overthinkers often argue they are simply waiting for the market to become safe, but there is always a headline about a looming economic recession, a global pandemic, a sudden war, or major interest rate changes, providing logical reasons to delay. This chart tracks decades of performance. Despite steep drops during major crashes, a broad trend line shows historical recovery and growth. The gap between this upward recovery and a flat cash savings account represents a mathematical loss that grows wider every year. Because the market is never completely certain, waiting for a state of total safety simply means you will be waiting forever. Shifting your focus from market prediction to consistency changes the outcome. This is the wealth builder approach. These investors ignore daily headlines and measure their progress in years instead of weeks. They follow a framework that prioritizes actual safety first, building an emergency fund and paying off high-interest debt before taking any investment risk. They learn the basics, create a long-term plan, and review their portfolio periodically rather than reacting to daily news. Steady, disciplined consistency has historically proven to be a more reliable driver of wealth than attempting to time a market crash. There will always be a new headline or expert prediction used to justify waiting one more month. Successful investors aren't necessarily the luckiest. They are simply the ones who start and allow time to do its work. Instead of asking when the market will be perfect, ask when you will be ready to stop waiting. Define one long-term goal today. Write down one specific fear you have about investing and take one actionable step to address it. Time is the engine of wealth, and you can never buy back the years spent on the sidelines.